Hi, this is Mike Palmer with Group1 Trading, and this is the Institute Volatility Sonar Report. Of course, on Friday, we were dealing with the big Brexit decision that came out at 1 a.m. Friday time. And for most everybody's perspective, that was pretty much an unexpected event. Going into Thursday's trading, if you remember Thursday of last week, we saw the VIX pull in dramatically. And the reason the VIX pulled in is because everybody really thought Remain was going to be the winner of that referendum. Of course, traders and every bookie agent in the UK, everywhere else, was ultimately wrong on that prediction. What happened next was we saw the VIX spike over 50% on Friday, and especially people didn't want to carry risk going into the weekend. After the market had a dramatic sell-off, the S&P 500 was down 88 points by the end on Friday. People really didn't want to carry any extra risk into the weekend. For that reason, we saw options in the S&P 500 bid up dramatically. We saw the VIX up dramatically. Now, right at that point, with volatility that high, we were pricing in the market to move over 2% a day. What happened on Monday is that the market was down, but it was only down modestly compared to where volatility was priced. And that is why you would see the market down about a little over 20 points in the S&P 500, but the VIX in dramatically as well. That's because the volatility that the market had been pricing on Friday, largely because we had a big sell-off on Friday, and also largely because people really wanted to cover themselves going into the weekend. You saw volatility very, very high going into the weekend, and the market did not move at that same volatility. It created that unique scenario where the market will be down significantly, but the VIX will be down as well because the market was actually pricing in more volatility than the market actually moved at. In order to maintain, just to remember, in order to maintain a VIX at about 30, you need the S&P 500 to move 2% a day. That is a very big number, 2% a day, when you're talking about an index that's trading about 21.5 or 20.5. So far today, we've actually seen the VIX come in again today, and that is because we had the big rally. That's what everybody's used to. We saw the VIX in $4.20 today. It's now below 20 again, but I will say that the interesting trading right now is we're starting to see buyers in the July options. We saw a big buyer of the July 19 straddles, different calls across the 20s, the 21s. The 21s have been very active today, and that is interesting that people are now buying volatility again in that July VIX contract. People are seeing that the VIX and the volatility of the VIX is going to remain a very volatile product until we get some clarity on what's going on with this Brexit. So what I would say now is that the VIX has been down with the market down. I would not say that's as significant as the fact that we're still seeing buyers of VIX options, that people are expecting a lot of volatility in the market between now and at least the middle of July, if not for the rest of the summer. And that is really what we're going to be looking at the rest of the year. This is Mike Palmer with Group1 Trading, and this is the Institute Volatility Sonar Report.